Welcome to a new podcast episode from the Fireside Chat series, a highlight of the Deal Forum at the 2024 Leadership in Dealmaking Summit, which was held on September 24th at the prestigious New York Athletic Club in the heart of New York City. We are making our Fireside Chats available to those who couldn't be with us in person and for those who would like to experience and listen to it again. Hello there, M&A Advisor community. This is Roger Aguinaldo, and welcome back to the M&A Advisor podcast. Since 1998, the M&A Advisor's mission is to recognize achievements, provide thought leadership, and connect professionals in mergers and acquisitions for the purpose of improving your deal-making craft and accelerating your deal flow. We are so glad you're joining us for this insightful and inspiring podcast conversation curated for mergers and acquisitions professionals. Whether you're an aspiring deal maker, a seasoned professional, or just curious about the world of mergers and acquisitions, you'll find something valuable and relevant in our podcast. Our goal is to bring you the best insights, stories, and tips from the experts who've been there and done that, so you can learn from their successes and mistakes and take your deal making skills to the next level. But before we dive into today's episode, we have a small favor to ask you. If you enjoy listening to our podcast and find it useful, please consider following us on Spotify, Apple Podcasts, and YouTube, and subscribing to our M&A Alerts newsletter. You can find the links in the description below. This will help us reach more people like you and grow our community of M&A professionals. It will also let us know that you appreciate our work and want us to keep producing more quality content for you. Plus, you'll never miss an episode, and you'll always be in the loop with the latest trends in the M&A world to improve and accelerate your deal making. So please follow us. You are the reason we do what we do, and we couldn't do it without you. And now for today's podcast. Continuing our Fireside Chat series from the Deal Forum at the 2024 Leadership in Dealmaking Summit, we join Sonali Basak of Bloomberg for a captivating finale with Rodgin Cohen. As the senior chair of Sullivan & Cromwell, Rodgin Cohen brings over 50 years of expertise in financial services law, earning the title of Titan of Transactional Practice. Sonali and Rodgin explore the complex landscape of banking mergers and acquisitions, regulatory framework, asset management, insurance, and cryptocurrency. A prolific author, Rodgin has penned essential works for banking and regulations, making this conversation a must-listen for anyone interested in the future of banking and finance.
Thank you all for having us. And Raj, it's so nice to be with you here again this year, pretty much a year after I last interviewed you here.
Well, I got asked and they said you were moderating, so I said yes. I didn't even look at anything else.
Well, it's a great time to talk to you because a lot is happening in your world at the intersection of M&A, regulation, and banking. And a good place to start is what's new, because you are seeing regulators having come out with new guidelines on the way bank mergers will work going forward. And when you took a look at them, how do you think that this will start to change the field?
So there were major developments last week. It took a while, but 3 government agencies, Comptroller of the Currency, the FDIC, and the Department of Justice, all came out with some version of what I would call merger guidelines. But I would say that the change was not substantial unless you are an FDIC insured institution, because when you look at what the FDIC actually said and review the comments of one of the directors, it seemingly evidenced a view that consolidation is disfavored. Why doesn't it make that much difference? There aren't that many bank mergers where the FDIC is the agency with an approval or denial authority. The controller of the currency, I think, listened to a number of comments and was more transparent in the final rules. It did not connote a merger. It seemed to say we're going to follow the policies we always have, which is to look at the facts and circumstances. And the acting controller issued a statement saying that they welcomed mergers, where healthy institutions were acquiring weaker institutions, and defined healthy not in terms of financial wherewithal, but having strong relationships with the regulators and the communities. And finally, the Department of Justice changed guidelines, which had been around for 29 years. It's somewhat inexplicable why the change was made, but what is perhaps of most significant is that today most bank mergers tend to be market extension mergers in terms of geography. And so the change that the Department of Justice makes in its formula really will not affect market extension mergers. With a big footnote, there's one sentence which suggests that the Department of Justice will look at submarkets rather than the more comprehensive approach on product markets, which they have used, and it remains to be seen how far that will be carried.
Very simply, now that there's some clarity around these rules, they've been discussed for a while. As you said, they haven't been changed in 29 years, and Jonathan Cantor at the DOJ has been trying to change them. Now that there's some more clarity, do you think that it will beget more mergers?
I think it will help. There is not another shoe to drop, so to speak, which is out there. The feet seem to be on the ground at all the agencies. And so the greatest enemy of mergers is not what the rules are, whether they are more restrictive or less restrictive. The greatest enemy is uncertainty. So your point is very well taken. I think this will encourage transactions.
How much pent up demand has there been for transactions?
I think there's a lot. If you look at this, and notwithstanding some of the what I would call scare tactics about how the American banking system has shrunk solely because of mergers and acquisitions, 2023 was the slowest year in bank M&A activity in at least 50 years. So just 1 year of not having activities. There's been a little more in 24, but only a little more. 22 was not a particularly robust year either. So I think there is pent-up demand, and there are a number of pressures beyond the regulatory, which are encouraging transactions.
It's hard to overstate the role that the Biden administration's regulators have had in mergers of all shapes and sizes, particularly large ones, and in the financial industry in particular, given that there are new rules being created. There's a very large merger out there that I know Sullivan and Cromwell has been working on, that is Capital One Discover. When you think about that regulatory environment, how prohibitive is it for deal making, and does anything change heading into the election?
So looking just at banks, principal regulatory problems have been, one, the uncertainty, which you mentioned, and two, the data on the number of banks that are ineligible to engage in transactions as an acquirer because of their regulatory stature. And the Federal Reserve has actually published some data on this, and a large number of banks simply are ineligible to make acquisitions. Now, that has not changed. That has nothing to do with these guidelines, but those two have been restrictive. I think when you go beyond banks, and I'm on a bit of tenuous ground here because it's something I will be far less expert on, but it does seem to me that the position of the FTC in particular has created uncertainty in the market as to what deals can go through and what cannot. And repeating myself, uncertainty is the greatest single enemy of bank M&A transactions.
What do you think that this administration has really been trying to accomplish? This was not in the world of M&A, but you saw the Department of Justice come down on Visa just today. Clearly, they're worried about consumers. You've seen a lot of the actions being taken by regulators really around the card industry more so than the banking industry right now.
Right.
What does that mean for consolidation?
So maybe I'm just being unduly optimistic looking through this with rose-colored glasses. But I think the administration, if you take the administration as a whole, has been trying to say that what they regarded as the permissiveness for mergers had gone too far. There are, however, various individuals within any administration, and some of those will have influence, and they are given a fair amount of latitude to do what they wish to do and carry out the vision they have.
Calling all M&A restructuring and corporate finance professionals. I'm Roger Aguinaldo, the creator and CEO of the M&A Advisor, and I have some great news for you. You are warmly invited to the exclusive Deal Forum at the 2024 Future of Dealmaking Summit on November 20th, 2024 at the prestigious New York Athletic Club in the heart of New York City. Light up your M&A career and ignite your deal-making skills. Join us at the all-new Deal Forum of the 2024 Future of Dealmaking Summit. This assembly gathers business insiders and deal makers to discuss the top trends, opportunities, and key issues facing the mergers and acquisitions market. The faculty, comprised of industry experts, participate in fireside chat sessions where they engage in insightful discussions moderated by prominent media personalities and thought leaders, keynote conversations, and M&A TV interviews. Finally, network, exchange ideas, and gain valuable insights in a face-to-face conversation with a thought leader of your choice in one-on-one meetings. To know more about the Deal Forum at the Future of Dealmaking Summit or to register, visit our website at www.maadvisor.com. That's maadvisor.com. Email us at events@maadvisor.com or call +1 212 951 1550. That's 212 951 1550. Don't miss out. Register now. The future of deal making awaits.
So what does this mean heading into the election? As a broad stroke, what do your clients ask you heading into November about the biggest risks to what they do?
Hey, so this is obviously the question which is top of mind for everyone. Will it change after the election? And the answer is we really don't know. And that's not just a question of who is elected president. There are multiple combinations of the House and Senate. I think the math is that there are 8 possible combinations when you look at what could happen in the presidential election, the Senate, and the House, and multiple permutations on top of those combinations. So we're really not going to know what will be the consequences until we know who wins the presidency, how the House breaks down, the Senate breaks down, and what people tend to forget, I believe, is who is going to be appointed to the key positions, whether it's at the Department of Justice, FTC, and there may be people who stay in place, the 3 banking agencies, and that is a process which will undoubtedly take a number of months to unfold and is quite uncertain and will be dependent on among other things, on who prevails in the Senate and by what margin. So I think as advice here, if you want to have greater certainty, you need to put your plans on the shelf for many months. I'm not sure that's very good advice because I think within boundaries, you'll know what's going to happen.
Well, but that's incredible. If people are putting their plans on hold and you're starting to map out the scenarios, when you think about those scenarios, is who is in cabinet positions more important for deal makers than who is in Senate?
Yep. In particular, the regulatory agencies. And the one key position in the cabinet is the attorney general. And again, we may have the same one, but really, waiting 6 months, that's a lifetime. And if you're sitting around waiting and your potential competitor for a deal says, I'm not going to wait forever. I've waited long enough. The first company is making a real mistake.
Well, it's fascinating to hear you say it's actually the attorney general being that very important position and not the FTC. Everyone looks at the FTC when you think about M&A right now. And is that because you see the DOJ coming out and making more?
No, it's the FTC. It's a good question. The FTC and the Justice Department sort of divide the world. Each gets a slice of the merger pie. Both are very important here.
So fast forward, let's kind of look past the election to the best extent that we can here. We do have new rules, as we've been talking about, going back to the beginning. One issue that used to exist, remember, if you think back to Silicon Valley Bank and the turmoil of that spring, one issue was that when assets became more troubled, the one player not able to get in was private equity. I'm curious about how that changes now that we have had a lot of people step back, look at this issue with a 3,000-foot view. Is there more demand for private capital into the banking system? Do you see more deals being done that way?
Well, I think there is certainly a receptivity by at least several of the banking agencies to private equity. And that's just not a guess because you look at transactions such as Banc of California, PacWest, where private equity is played a major role, at New York Community, where private equity played a major role, a much smaller one, First Sun and Home Street, where private equity is playing a major role. I don't think there is an allergy at the Federal Reserve to private equity.
Well, that's remarkable as well, because that seems to be a very large culture shift.
I think it is, and you're right to talk about a culture shift because the receptivity of the bank regulators to private equity has waxed and waned over the last 20 years or so. Right now, I guess it's waxing.
So why do you think that is? At the end of the day, you were talking a little earlier about the fear-mongering around the number of banks shrinking, but they have shrunk, and you are seeing private capital stepping in and playing a bigger role, not just in traditional banking markets like mortgages. For example, is private capital just a new reality? You have to accept it, otherwise where does the capital come from?
Right. I think that's very well said. It is the new reality. And there is I think, an objective of the regulators to encourage capital investment into the banking industry. And, there are only a limited number of sources just by definition. And the public markets are only there to an extent, and the private markets can help fill whatever gap there is.
It's interesting. Another piece of the private markets as well. We were talking about financial services deals. We kind of hinted at the idea of more bank mergers. We're talking about credit card deals as well. But it's also asset management deals that have been booming.
Absolutely.
And how is kind of this demand for private credit and kind of the consolidation that is so needed, perhaps, in a much more fragmented world of asset management changing kind of the texture of the deals that you're seeing out there?
So this is a great question, and there are so many streams of development which are feeding into the asset management consolidation. One is clearly the need for scale. It is in large part a scale business. A second critical factor here is the relationship between insurers and asset management. And in some cases, such as AXA, but there are others as well, where insurers have decided that the most efficient, effective way to run their business is to have somebody else manage the assets, and they go about their business of being a great insurer. And this is a third, an area where there seems to be more willingness to do transactions cross-border. And so I would be surprised if we were sitting here a year from now and there had not been more asset management transactions.
Well, that's interesting. Which part of the market do you think will be the most heated over the next 12 months in terms of asset management M&A? For the point that you're making, BlackRock alone this year made 2 massive deals to expand it into private assets. In insurance as well, you see kind of the large getting larger with the KKR and Global Atlantic becoming a bigger force combined.
Right. There are probably several of these. One is the last one you mentioned, which is clearly key. The large private equity firms which have purchased insurers will continue to grow the asset management aspect of that business. And this all comes back to it being a scale business. I think a second area, and it's almost the opposite side of the coin, is asset managers or companies which have asset management but are not up to scale will be seeking to really leave the business or limit the business because they lack the scale. And third, and I'll go back my stream of development, I think you will see the cross-border transactions that is most likely to be acquisitions of U.S. Asset managers, because I think this is where everyone wants to be. If you ask, what is your priority as an asset manager? It's got to be the U.S.
So that's fascinating. You're saying that there are asset managers that are based in Europe or elsewhere in the world that are currently hunting across the U.S. with asset managers.
Yes.
So when you think about the insurance play, to extend on that for a moment, there are some very notable firms. Apollo, probably the most notable. KKR, as we talked about. Is this M&A landscape one where only the large survive, right? Are there the bigger firms that have to keep acquiring, or do the smaller firms have a chance?
So this actually goes all the way back to our original question as well as to the thesis about consolidation. And is it a positive, a negative, or as I believe be the case, does it depend on the merger and the transacting parties? I think there remains a room for asset managers of below a certain size, provided they're not trying to be all things to all people, because that's where the lack of size will really be an obstacle. If, in contrast, they are highly focused, I think there is room for smaller asset managers.
At the end of the day, because of the regulatory environment as it exists, is that maybe the case for those smaller deals?
To an extent, yes.
So if you kind of roll forward again from the next 12 months, we were talking so much about the pipeline. You said you expect more bank mergers, more insurance deals, more kind of cross-border deals among asset managers. How do you think that changes the financial landscape moving forward?
Again, I think that mergers are not, as a concept, good or bad. And so the financial landscape will be strengthened to the extent that the mergers are sound, well thought through. But if it is just acquires on an acquisition spree to be larger because it's better to be larger, that is ultimately not the best result. And I'm reminded this takes me back a number of years ago, but I was at a conference. I'll never forget this night. I walked in late, and I will confess, been a very long and very delayed plane flight. And went into the hotel bar, and there were a group of at that point bank CEOs who were gathered around, and the question was mergers and why do you do it with so forth. And I was only on my first drink. They were well ahead of me. And one of them said, and he is, by the way, no longer active, he said, well, I do mergers because it sure beats working. And I always thought that indicated where some individuals are.
That's also very interesting. Do you think that banking? I think a lot of people forget JP Morgan was built on a series of acquisitions.
Right.
It's been what has created the industry that we live in now. And so I'm wondering, throughout your career, have you seen the pace kind of get faster or slower over time?
I think it speeds up, slows down, it's cyclical. And JP Morgan is actually a great example. I'm going to go back a few years before I was involved, but people forget that in the 1960s, JP Morgan tried to break out of the original JP Morgan tried to break out of its position as a big New York wholesale bank and acquire a whole group of upstate banks in New York. And it was turned down on competitive grounds on a now discredited theory of potential competition. So, it's very difficult to predict the future, because if JP Morgan had succeeded then, would you have ever had the JP Morgan of today? And would that have been better or worse? Who knows?
It's that the thing that you said about kind of the bar anecdote here. That can banks really grow without mergers very easily at this juncture?
I think it depends on which banks. Again, scale has become so important in the banking industry as well as asset management. And it's become important because in the 80s, 90s, first part of this century, scale was a back office issue. Today, it's a front office issue. How many different channels can you utilize to attract customers? So scale, again, is so important. And if you have achieved that scale, I think you can continue to grow organically and grow at a fairly rapid pace. But below that, it's much more challenging.
I have a few more questions for Raj, but we'll also open this up to the audience if anybody else has questions for Raj. His advice would otherwise be very expensive, I imagine. I said I was doing this conversation, and somebody had mentioned, by the way, that you are kind of the greatest of all time at this point, as otherwise known as the GOAT, called on by pretty much every bank CEO in the world these days. But, you think about not only U.S. bank consolidation, but anyone trying to enter the U.S. You mentioned international consolidation. There has been in other industries a large resistance to that. Do you think that would be the same for the asset management industry, the banking industry, the insurance industry as well?
So it's a fascinating question you ask. And in effect, am I wrong about asset management coming into the United States? I think I am not. But the reason I'm now re-raising the question is when you look at banks outside of the United States, many of whom had a substantial commercial banking presence 20 years ago, and so many of them have left. Barclays now has only a credit card operation. HSBC has shrunk its position. National NatWest left the market entirely.
TD is facing a large probe.
TD has an issue. BBVA left, BNP left, MUFG left. All the major foreign banks that had a substantial presence have really left, other than the Canadians and Santander. I may have left out one other. So what is it? Did they all pick the wrong horse to ride in the United States? Some did, but banking may just have more of a cultural barrier, commercial banking, than asset management.
What about also, of course, the bank capital rules? There's also always been kind of this sense under the surface that the minute you finally have them, the new rules, that there would be another wave of consolidation that would rise to meet those requirements that are being placed on capital at this point in time.
So we're all waiting with bated breath and keep waiting and waiting and waiting.
Right, we're waiting forever.
Right. I think Samuel Beckett wrote the play on the capital rules, and there apparently is another delay. But I do think the capital proposal that Vice Chair Barr outlined, it's going to be far from perfect. Any capital regime would be, but it really, I think, balanced competing considerations. And I don't think in and of itself it will encourage consolidation just because banks are facing some insuperable capital barrier. The more serious issue may be the proposed long-term debt requirement, because the impact on bank earnings could be substantial for the banks that are affected. That could make a difference.
There's also a lot of technological innovation, cryptocurrencies, artificial intelligence, and fintech in general. If I sat here with you 3 years ago, we would be wondering about Apple and banking.
Right.
We are less worried about that today, or at least a banker would be, than they were maybe 5 years ago with the partnerships they've struck. How do you think technology, crypto, AI is changing your job and the job of the people that you advise?
Sure. So let's start with AI, and I'll keep harping back to scale. Innovation is good, but at the beginning, it is very expensive. And AI, of course, is what innovation is all about today. But the larger you are, the more you can absorb the costs of implementing AI. And the larger you are, the more you can afford to experiment with AI. So I think, again, AI and innovation generally favors scale. Insofar as cryptocurrency is concerned, I'm going to pause and start with a caveat, which is the following. If you want a sure way to make money, it is to bet against Congress legislating in any area. You believe me.
For how long?
Forever, if possible.
Really?
But now I'm going to, with that caveat, I think there is so much support for cryptocurrency legislation. We will see that, maybe even before there is a new president, and perhaps even before there's a new Congress seated on January 6th. There's a lot of momentum. There are a lot of reasons to have legislation in an area, and as opposed to just letting it develop without any real guardrails, other than New York State, which has been doing, I think, an excellent job, but New York State can't police the world. So we're going to see that. And the question, one key question will be, does that legislation leave banks out in the cold on cryptocurrency? Right now, the three federal bank regulators have said, let's consider the issue, but it's being considered for, again, a very long period of time. And the question is, what will the legislation do to enable banks to engage in cryptocurrency activities? But without getting into the specifics, the idea that you could have an alternative financial system without any regulation makes no sense. I think every responsible cryptocurrency organization, whichever area they are in, recognizes that, supports responsible legislation.
Well, what type of legislation do you think gets done in the near term by the end of the year, or at least before January 6th?
I would think, and there's so many competing bills right now, but the legislation would, among other things, make clearer the application of the AML, BSA, Anti-Money Laundering, Bank Secrecy Act requirements, the sanctions requirements, capital backing, reserve backing for cryptocurrencies, resolve this jurisdictional dispute between the Securities and Exchange Commission and the CFTC as to who should enforce. Is it a commodity? Is it a security? I mean, when those two statutes were passed, obviously nobody had heard of cryptocurrency. So we're trying to fit the proverbial square peg into a round hole. So let's settle the jurisdiction.
Well, what do you think happens as far as jurisdiction over this?
I really do not know. I mean, it is a battle royal between the agencies and between competing visions in both Congress and cryptocurrency providers.
So you mentioned whether banks will be left out in the cold. What role do banks really play in this kind of burgeoning ecosystem? We know that BlackRock has already staked their ground in asset management with ETFs. But what about the banks?
Well, there is no reason why banks shouldn't be involved in cryptocurrency in every aspect. Let's start with, one would have thought, the simplest, which would have been just to custody the assets. But the SEC came out with a staff accounting bulletin, which made it impossible for banks to do so because it would impose balance sheet and therefore capital requirements. And although the chief accountant recently gave a speech where he seems to open the door, that's a real issue. But the fundamental issue, again, is the three bank agencies have said, we don't want you to engage in crypto activities without our permission, and none of them has yet given permission. But I think all of this, banks perform this critical role in the economy, which is to provide virtually all financial services. So why should they not provide crypto services?
It's interesting, to your point on New York, one of the larger stablecoin issuers in the world, Circle, just moved their headquarters here as well. So you kind of see that movement. I will open the floor up if anyone has any questions.
Hi, Roger Aguinaldo, CEO of the M&A Advisor. Thanks for coming again, Sonali and Rodgin, again this year. Last year, you were here when there was a bank run on, those West Coast banks. So that was...
and one in New York.
And one in New York, correct. So, I think that's what prevented maybe some investors from investing in banks specifically. But you mentioned asset management. I started my career at Merrill Lynch, where we were buying asset managers, or our clients were buying asset managers that were of scale of, back then, 80 million mutual fund, right? So 80 million is nothing today. So you've worked on too big to fail, right? So there is, I think, and I coined this phrase, so if anybody takes it, too small to scale, right? So you're talking a lot about scale. I think if private equity investors, where they're investing is a lot of these RIAs, consolidation in these asset managers or asset brokers, consolidating on sort of every level. And insurance companies, Sonali, you mentioned that. Private equity is, very big into insurance and has been trying to develop and invest in permanent capital vehicles. So my question is twofold. One is, what other areas or do you see consolidation for investors, again, from an investor standpoint? And what is too small to scale, meaning let's not play this game of trying to consolidate. We're going to be sellers, right? As an investor, I've hit this level of AUM of, 10 billion, I don't know, 2 billion or whatever. What is that? What is that scale level in which you should be a seller versus a buyer?
Okay, so let me actually spend a little bit of time on that question and that second question. And it may sound foolish for me to try and speculate. I mean, why would you say what is the right number? I actually believe it's a very pertinent question. I'm going to try, therefore, to answer it. I think the too small to scale in the banking industry is primarily what I call the tweeners. The banks which are regulated as almost as if they are really large, but are not really that large. And there are the break points. The single principal break point is $100 billion in assets at the present time. So you can't say what the ideal scale is, but I think what you can conclude is the most ridiculous amount of assets to have is $101 billion, because then you have the full regulation as if you were 5 or 7 times larger, and you don't have the scale to deal with the expense of that regulation. So I do think you're going, and you hit the nail on the head, where you have regulatory breakpoints, 10 billion, a little bit, 50, and a lot at 100, you're not going to see banks just below those numbers because organically they'll get over them and then they have a real issue. So that's where I think you will see the inorganic growth through consolidation.
And the different areas also, so you're talking about banks. I think investors, because of the heavily regulated environment in banks, are going more towards insurance, which is regulated, but they've been able to do that, and RIAs and brokerage and
it's a very, you're making another really good point. It's regulated, but it's a very different type of regulation. It is not that insurers are not tightly regulated in terms of prudential regulation, but the affiliation restrictions of the Bank Holding Company Act do not apply. And that is, and certainly it doesn't apply to asset managers. So if you are a pool of private capital, you shouldn't object so much to the regulation at the operating level, but what you would object to is prohibitions on what else you can do.
I'm going to take one more question. There's one back here.
Thank you both for this session. Very informative. My question is, you both talked about how M&A is cyclical. As we go from one cycle to the next, what would be some key takeaways or lessons to take for all of us to learn from?
Lessons from, I'm sorry?
To go from the current M&A cycle to the next, just to be aware of, kind of to get ahead on some of those things.
So I think, first of all, the lesson is to recognize that it is cyclical and that you need to be prepared because sooner or later the cycle will end. And, if you take, most of my time is spent on banks but with a fair amount of time on the rest of financial service, I just feel more comfortable sometimes talking about banks. you have just a small number of really important targets if you're doing your strategic plan and looking as an acquirer, or the reverse. If you're a seller, there are only one or two that make sense. If you wait and don't start the exploration, you wake up one day and your opportunities are gone. And at the risk of one more war story, at one point this one goes back about 30 years ago, there were 4 large banks in California. And the CEO of one of them, again, no longer, of course, there, said he was not worried about a hostile takeover because any of the other 3 that made the hostile overture, knew that the other 2 would bid for him and he would favor one of the other 2. And that was a great strategy until 2 of the 4 got together. That left only 1 who could do a hostile, and they did it in about 3 months. So it's planning ahead. That's to see through these cycles and planning for them. So this question about cyclical behavior is really an important one.
Thank you.
Makes me glad I've learned chess. Thank you so much, Raj. Thank you guys for having us. This has been lovely.
Thank you so much, Sonali. A pleasure as always.
We hope you enjoyed this episode and learned something new from it. If you have any questions or comments for us or any of our guests, please feel free to leave them in the podcast platform of your choice or send us an email at editor@maadvisor.com. We would love to hear from you and get your feedback. And if you haven't done so already, please follow us on Spotify, Apple Podcasts, YouTube, and subscribe to our M&A Alerts newsletter at the links in the description or on our website at www.maadvisor.com. This will help you stay updated on the latest M&A interviews and trends and support our podcast to grow and reach more listeners like you. This is Roger Aguinaldo, the creator and founder of the M&A Advisor. Thank you for tuning in and being part of our M&A Advisor community. Until next time, stay safe and happy dealing.